All right, so Walgreens, huh? They were like the poster child for reliable dividends for years, just consistently raising those payments. And then, boom, big cut in 2024. And now, just a year later, they completely suspend the dividend.
Yeah, it's
It's kind of a head scratcher,
it really is.
especially if you're someone who, relies on those dividends for income. Or maybe you're thinking about, adding Walgreens to your portfolio.
Right.
It definitely makes you wonder what's going on.
Well, and what's really striking is that they had this incredible 47-year streak of dividend increases.
Wow.
47 years. I mean, it almost felt like you could just set your watch by it. But I guess what we're seeing now is that even decades of consistent payouts, it doesn't necessarily mean anything for the future.
Yeah, you'd think a track record like that means they've got it all figured out. But,
Right.
but this Motley Fool article that we're looking at today, it really highlights some crucial points that I think all dividend investors need to understand. And that first one is, even after a company cuts its dividend, there's still no guarantee they won't cut it again.
Absolutely.
Or even, suspend it entirely like we're seeing with Walgreens.
Yeah, it's tempting to think, okay, they adjusted, things are stable now. But you got to remember, they slashed that dividend by almost half, like 48% back in January of 2024. And I mean, that was supposed to free up cash, but the fact that they had to completely suspend payments just a year later, it just makes you think there were some bigger problems going on behind the scenes.
Exactly, yeah. So those impressive dividend streaks, as much as we all love to see them, they're not a foolproof shield.
Nope.
I mean, Walgreens, 47 years, it's like a textbook example of how things can change seemingly overnight.
It really underscores how important it is to look beyond just the historical data. I mean, don't get me wrong, past performance is valuable, it's information. But if you really want to know if a dividend is safe, you got to scrutinize the company's financials right now, today. Look at their strategy. What are they doing? Where are they going? What are their future prospects? Those factors paint a much clearer picture than just, looking at how they've paid dividends in the past.
Makes you wonder, though, if there were any warning signs. Did this just come out of nowhere, or were there hints that maybe things weren't as rosy as they seemed at Walgreens?
That's a great question. And this is where it gets interesting. The Motley Fool article, it points out that Walgreens was in the middle of this really ambitious and expensive growth strategy. They were opening hundreds of healthcare clinics all over the country, which obviously, you got to spend money to do that, right?
Yeah, of course.
It requires a lot of investment. And at the same time, their financial performance was, well, not exactly stellar.
Yeah, the article mentioned operating losses of over $1.5 billion. Yeah. In just the 2 fiscal years before they suspended the dividend. And those kinds of losses, that definitely doesn't inspire a lot of confidence. Could you break that down a little bit for us, for our listener? What does that actually mean when a company is reporting operating losses? Like, what does that tell us about their business?
Sure, yeah. So operating losses basically mean that Walgreens was spending more money on its core business operations than it was bringing in.
Oh, okay.
Through sales and, other revenue streams.
Yeah.
So for a company like Walgreens, it could be a lot of things contributing to that. It could be rising drug costs. Maybe their retail sales are down. Maybe there's just more competition now.
Yeah.
In the pharmacy and healthcare space.
So they're putting all this money into this huge expansion, but at the same time, their core business, the thing they've always done, it's actually losing money.
Yeah.
It seems like a pretty risky combination.
Yeah, you're right. Ambitious growth plans and then shaky financials, that's definitely a red flag for any investor, I think.
Yeah.
Whether you're focused on dividends or not. The article actually compares it to what happened with Intel, which also just recently suspended its dividend. They were facing kind of similar problems.
Yeah.
Financial challenges, and then also trying to do all these big new growth initiatives at the same time.
It sounds like there's a lot more to uncover here. So I guess the question is, what should investors really be looking at? Beyond just those dividend streaks, what are some of the things that can give us a clue, a better sense of a company's financial health?
Well, one of the most important things is to really dig into those financial statements.
Yes, those financial statements. But let's be real, I'm not a financial analyst.
Yeah.
And I'm guessing most of our listeners aren't either. So what are some tips for the everyday investor? Someone like me or our listener who wants to try to spot those warning signs, those red flags before it's too late. Where do we even start?
Yeah, no, you're totally right. Those statements can be super intimidating.
Yeah.
But you don't have to be a whiz to understand the basics. One of the most helpful reports, and it's a great starting point, is the cash flow statement.
Okay.
Think of it like the company's financial diary. It basically tracks where the money's coming from and where it's going.
Okay, the cash flow statement. Got it.
Yeah.
But what are we actually looking at? What should set off alarm bells for us?
So you want to look for trends, especially when it comes to the company's ability to generate cash from its actual operations. Can they cover their expenses and still have enough left over to pay dividends?
Right.
Or are they relying a lot on debt to finance those dividends or to fund those big growth plans we talked about?
So if the cash isn't coming in from the core business, those dividends are on shaky ground. Makes sense. But what about companies that are consistently profitable? Doesn't that mean like automatically they can afford to pay dividends?
That's a really good point, and it's a mistake people make all the time. Profitability is important, for sure, but it doesn't always tell the whole story when it comes to whether dividends are sustainable.
Right.
Remember, Walgreens was still showing a profit, a net profit, even with those operating losses we talked about.
Interesting.
That's because profit can be affected by things like, if they sell off assets, or if they have a one-time gain, or even tax benefits. That stuff doesn't always reflect how healthy the underlying business really is.
Okay, so profits alone don't guarantee dividend safety. Gotta look at the cash flow. But going back to Walgreens for a second, they had this incredible track record, right?
Right.
Almost 50 years of raising dividends. Couldn't that be a sign that they were really committed to rewarding their shareholders, even if they hit a rough patch?
Well, a long history of increases is definitely a good sign. I mean, it's not nothing.
Yeah.
But you have to remember that dividends are ultimately, at the end of the day, they're optional. The board of directors, they can always decide to cut them or suspend them.
Right.
Especially if they think it's what they need to do to keep the company financially healthy.
And it seems like in this case with Walgreens, they felt like they had to focus on getting their finances in order, even if it meant letting down those investors who had been counting on those dividends. It's tough, but I guess it just shows you have to be ready for anything.
Absolutely. You can't always predict the future based on the past. And even companies with great track records, they can change their dividend policies in a heartbeat. That's why it's so important for investors to stay informed, to do their research, and to really be looking at those financial statements. You can't just take those dividends for granted.
Yeah, it's like we always say, hope is not an investment strategy. So thinking about Walgreens and other companies that might be in a similar boat, what are some key takeaways? How can we avoid getting caught off guard like this?
The key is to be proactive,
Right.
to do your homework.
Right.
Don't just rely on a company's dividend history or how much they're currently yielding. You got to really take the time to understand their financial situation, look at that cash flow, and think about their long-term prospects.
And don't forget, there are resources out there to help. Like The Motley Fool, for instance. They offer some really in-depth analysis and recommendations.
Oh, yeah. Sure.
That can be super helpful when you're trying to figure out what to invest in.
Yeah. There's tons of info out there. And a lot of it, anyone can access it.
Right.
Don't be afraid to ask questions. Really dig into those financial statements. And, don't just assume everything is what it seems.
That is really good advice. This whole deep dive has honestly been a real eye-opener for me, and I'm already thinking about how I can use this stuff, when I'm looking at my own portfolio. It's definitely a reminder to pay attention, to be on top of things, and just never stop learning.
That's the spirit. Investing, it's a lifelong journey. And the more you know, the better you'll be able to handle those ups and downs in the market.
That's true. Well, as we wrap up our deep dive into this Walgreens situation, what's the one thing you want to leave our listeners with today?
I'd say the most important thing to remember is this. Dividend investing can be a fantastic strategy, but it really demands that you're an active, informed investor. You can't just get lulled into this false sense of security by a company's dividend history or, just because the yield looks good. You've got to peel back those layers and understand how healthy their financials really are.
Okay, so we've talked about how we can't just rely on dividend history or even profitability. We've got to go deeper. But if we're not all, financial experts, what's one key thing that our listener could check that might give them an early warning about, potential dividend risks?
That's a great question. And it gets to the heart of being a smart dividend investor. I would say focus on free cash flow.
Free cash flow?
Yeah. This is the cash that a company is left over after they've covered all their essential operating expenses and capital expenditures. It's basically the pool of money they have to, reinvest in the business, pay down debt, buy back shares, and of course pay those dividends.
Okay. Free cash flow. Sounds like a pretty important metric. So how do we know if a company's free cash flow is healthy enough to support their dividend? What should we be looking at?
So the key is to compare the free cash flow to the actual dividend payments. Is the company generating enough cash to cover those dividends comfortably?
Right.
Or are they having to, like, stretch, maybe even dip into debt just to keep making those payments? If it's the second one, that's a huge red flag.
Yeah.
Because it tells you that dividend might not be sustainable over the long term.
So strong free cash flow? Good. Weak free cash flow? Be careful. Makes sense. But isn't analyzing free cash flow kind of complicated?
It might sound intimidating, but it's actually more straightforward than you think.
Okay.
A lot of financial websites, they just give you this information.
Mm-hmm.
And you can actually calculate it yourself using the company's cash flow statement.
Mm-hmm.
You just subtract capital expenditures from cash flow, from operations, and boom, there's your free cash flow.
Wow, that is easier than I thought. So we're looking for companies with strong and consistent free cash flow that can easily cover those dividend payments. That's a really valuable insight, especially, after what happened with Walgreens.
Exactly. Free cash flow, it's like the company's financial fuel gauge. If it's running low, that's a sign they might not have enough in the tank to keep paying those dividends. Of course, free cash flow is just one piece of the puzzle, right?
Right.
You still want to consider the company's overall financial health, their strategy, the industry they're in, all that stuff. But free cash flow analysis, it's a great way to maybe spot some of those warning signs early on.
This whole conversation has honestly been a masterclass in dividend investing. I feel like I've learned so much, and I'm sure our listener out there has too.
Well, we're all students in the market, right?
Yeah.
Always learning, always trying to get better at this. The more we understand, the better decisions we'll make.
Couldn't agree more. Well, listeners, that brings us to the end of our deep dive into the Walgreens dividend suspension. We covered a lot of ground today, from the allure and, the limitations of dividend streaks to the importance of really digging into those financial statements and, of course, that power of free cash flow analysis.
And I remember the key takeaway here: be engaged, be informed, don't be complacent, dig deeper, ask those questions, and be ready for the unexpected. The market is full of surprises, and sometimes those surprises come in the form of a suspended dividend.
That's right. But armed with knowledge and that critical eye, you can navigate those challenges and make investment decisions that really align with your goals. Until next time, keep learning, keep exploring, and keep diving deep.
And as always, invest wisely.